In the realm of investments lies a powerful truth. By minimizing risk per unit of return, we unlock the path to higher and more consistent returns. By doing this, we create a portfolio that is fortified against any single risk or combination of risks that may threaten its success. It is through this careful balance that we find equanimity, knowing that our investments are shielded from the storms that may arise. Within this vast landscape of risk, we encounter diverse adversaries: market risk, credit risk, liquidity risk, and event risk loom on the horizon. Yet, if we adopt tailor-made strategies to handle each of these risks separately, our portfolio will be able to handle these shocks with ease. By following these strategies, we reduce risk while maximizing the potential for reward. By harmonizing risk and return, we forge a path to a higher and more consistent stream of returns. And as our portfolio grows stronger, we can sleep peacefully, undeterred by the fear of a single or even a combination of these risks unraveling our portfolio. As human beings, we tend to experience more pain from potential losses than pleasure from potential gains. This psychological bias often leads us to avoid risk altogether. However, avoiding risk is not a viable long-term strategy if we want to generate sufficient returns to achieve our financial goals. To effectively navigate risk, it is crucial to measure it. Traditional measures like standard deviation or variation alone may not be helpful in dealing with risk. Instead, we need to identify the sources of risk to better understand how to deal with them. There are two main sources of risk: systematic risk and idiosyncratic risk. Systematic risk affects the entire market or multiple assets together, while idiosyncratic risk impacts individual securities or a subset of securities. Let us next explore some examples of these sources of risk. Systematic risk includes interest rate risk and market risk, which influence the overall economy and market conditions. On the other hand, idiosyncratic risk encompass liquidity risk, currency risk, credit risk, political risk, and inflation risk as they pertain to specific sectors or securities. Let's start with credit risk. Credit risk refers to the possibility that a borrower may not repay the money they borrowed. It arises when there is a chance of default or delayed payment. For example, if you lend money to a friend who has a history of not repaying debts, there is a credit risk involved. If your friend fails to repay the loan, you may not receive the full amount or any repayment at all. Credit risk is best handled by strategies like due diligence and margin of safety. Due diligence. Conduct a thorough research and analysis before making investment decisions. This includes evaluating the financial health of companies and understanding market trends. Margin of safety. By investing at a price significantly below the intrinsic value of an asset, you create a cushion to absorb potential losses. Credit risk pertains to the possibility of borrowers defaulting on their debt obligations. To address this risk, conducting a thorough due diligence is crucial. Combine the strategy of due diligence with diversification by investing in bonds or loans issued by multiple borrowers. By carefully evaluating creditworthiness and diversifying your credit exposure, you can mitigate the impact of credit risk. Next, we cover liquidity risk. Liquidity risk is a risk of not being able to quickly sell an investment without incurring substantial losses. It occurs when there is a lack of buyers or a limited market for a particular asset. For instance, if you invest in a rare collectible item that has a small pool of interested buyers, it may be challenging to sell it at a fair price when you need to convert it into cash. Liquidity risk can be best handled by avoiding securities which are less liquid. However, if such securities are very attractive Then they can be bought in a group using a strategy called diversification. Diversification. Spreading investments across various asset classes helps reduce the impact of individual security risk. This is the old adage of not putting all your eggs in one basket. To mitigate this risk, one strategy is diversification. By spreading your investments across various assets and sectors, you can reduce the impact of liquidity risk. Investing in both liquid assets like stocks and less liquid assets like real estate or private equity can provide a balance. The next big risk that we will cover is interest rate risk. Interest rate risk refers to the potential impact of changes in interest rates on investments. When interest rates rise, the value of fixed income investments like bonds tends to decrease and vice versa. For example, if you hold a bond with a fixed interest rate of 5% and market interest rate rises to 6%, newly issued bonds will offer higher interest rates, making your bond less attractive to investors and potentially reducing its price. Interest rate risk can be best handled by delaying investments to a later date when the risks may be lower. Holding cash. Maintaining a cash reserve provides flexibility during times of market uncertainty and can be utilized to take advantage of favorable investment opportunities. By delaying investment in debt securities that will be impacted by a rise in interest rates, we can turn a threat into an opportunity. By entering such investments when interest rates are higher, we improve our risk to reward ratios. Next, we turn to the biggest risk of all, market risk. Market risk is a general risk associated with investing in the overall stock market. It refers to the possibility of experiencing losses due to factors like economic conditions, geopolitical events, or market volatility. For instance, if you own stocks in a company, a market downturn caused by a global financial crisis can lead to a decline in the stock prices across the entire market, affecting the value of your investments. Market risk is best handled by taking a gradual entry and exit strategy from the market. Systematic investment plans. Regularly investing fixed amounts at predetermined intervals can mitigate the impact of market volatility over the long term. Long-term investing. Focusing on long-term investment horizons allows you to ride out short-term market fluctuations and benefit from compounding growth. By adopting a long-term investing view and by investing small sums regularly, investors can reduce the impact of sudden market declines or market risk on their portfolio. We next turn to inflation risk, which most investors have experienced in the last 1 year due to commodity shortages and the Russia-Ukraine war. Inflation risk is a risk that the purchasing power of your money decreases over time due to a general rise in prices. It erodes the value of money and can affect the return on investments. For example, if you keep your savings in a low interest savings account and the inflation rate is higher than the interest rate you earn, the purchasing power of your saving may decline over time, making it harder to afford goods and services in future. Inflation risk. Inflation risk arises when the purchasing power of money decreases over time due to rising prices. To combat this risk, consider combining asset allocation with investing in real assets. Real assets such as real estate or commodities tend to have a positive correlation with inflation. By allocating a portion of your portfolio to real assets, you can potentially offset the erosion of purchasing power caused by inflation. This is because as inflation rises, the discounted cash flow of growth stocks falls much more than value stocks, as growth stocks are priced based on many more years of earnings growth than value stocks. Investing always involves some degree of risk, but with proper understanding and informed strategies, you can navigate these risks effectively. Remember to measure risk by identifying its sources, apply suitable risk management strategies, and stay focused on your long-term financial goals. Happy investing!